ZAUSD is a common symbol in trading. It represents the price of gold, quoted against the US dollar. It's one of the most traded pairs, and many global traders watch ZAUSD closely. Its movements can reflect economic health. Gold has always been a precious metal, and understanding it is vital for traders. Gold holds significant appeal for many investors. Traders often choose ZAUSD for several reasons. It is widely considered a safe haven asset. During times of economic uncertainty, its value can increase. Gold can also act as a hedge against inflation. Furthermore, ZAUSD offers high liquidity in the market. This means trades can be executed quickly and easily. Its popularity draws a diverse range of market participants. ZAUSD is well known for its price volatility. The value of gold can change very rapidly. These quick price movements offer trading opportunities. Traders can potentially profit from these swings. However, this volatility also brings higher risk. Significant losses can occur if trades are not managed. Careful planning and risk control are essential. It demands a thoughtful approach from every trader. To trade ZAUSD successfully, a clear strategy is needed. A trend-following approach can be very effective. This method helps traders navigate the market's swings. This essay will explore such a strategy. The trend follower strategy is straightforward in its concept. Its main goal is to profit from established market trends. First, traders identify a clear price direction. Then, they place trades that align with that direction. This strategy avoids going against the prevailing market momentum. It tends to perform best when markets are clearly trending. It is less effective in sideways or ranging markets. The core idea is to ride the wave of the market. We use moving averages or MAs as key indicators. The 50-period MA helps identify the medium-term trend. The 200-period MA indicates the long-term trend. When the price is consistently above these MAs, it suggests an uptrend. Conversely, if the price is below these MAs, it suggests a downtrend. These MAs act as dynamic support or resistance levels. They provide a clear visual guide to the current trend. Traders rely on them for trend confirmation. The Relative Strength Index, or RSI, is another important tool. We typically use a 14-period setting for the RSI. This indicator measures the speed and change of price movements. It helps identify overbought conditions, usually above a level of 70. It also shows oversold conditions, usually below a level of 30. The RSI can help traders fine-tune their entry points. It helps avoid entering trades at price extremes. Momentum confirmation is a key use of the RSI. Suitable timeframes for this strategy include H1, H4, or daily charts. Longer timeframes often provide clearer and more reliable trend signals. Shorter timeframes can have more noise and false signals. Support and resistance levels are also vital components. Support is a price level where buying pressure may overcome selling pressure. Resistance is a level where selling pressure may overcome buying pressure. We integrate these levels with MA signals and trend direction. This helps pinpoint potential entry and exit zones effectively. A buy signal typically emerges within an established uptrend. First, the price should be trading above the 200-period MA. This confirms the long-term market sentiment is bullish. Next, wait for the 50-period MA to cross above the 200-period MA. This event is widely known as a golden cross. After this, the price should ideally pull back. This pullback might be towards a support level or the 50 MA. This indicates a potential buying opportunity in the uptrend. To confirm a buy signal, check the RSI indicator. The RSI should not be in the overbought territory, above 70. Ideally, the RSI is rising, perhaps from below 50 or from oversold levels. Look for bullish candlestick patterns forming at the support level. Examples include a hammer or a bullish engulfing pattern. All these conditions should align for a higher probability trade. Patience is crucial. Wait for the setup to fully form. Do not rush into a trade before confirmation. A sell signal generally appears during an established downtrend. First, the price needs to be trading below the 200-period MA. This indicates that the long-term market sentiment is bearish. Then watch for the 50-period MA to cross below the 200-period MA. This crossover is commonly referred to as a death cross. Following this, the price should ideally rally upwards. This rally might reach a resistance level or the 50 MA. This presents a potential selling opportunity within the downtrend. To confirm a sell signal, assess the RSI indicator. The RSI should not be in the oversold territory below 30. Preferably the RSI is falling, perhaps from above 50 or from overbought levels. Look for bearish candlestick patterns at the resistance level. Examples include a shooting star or a bearish engulfing pattern. It is important that all signals converge for a stronger setup. Always wait for these confirmations before executing a sell trade. This disciplined approach improves the quality of trading decisions. Risk management is absolutely critical in ZAUSD trading. Gold prices can be extremely volatile and move sharply. Without proper risk controls, significant losses can occur rapidly. Therefore, a stop-loss order is essential for every single trade. A stop-loss order automatically closes your position at a predefined price. This action limits your potential loss on that trade. It is a fundamental tool for protecting your trading capital. Never trade ZAUSD without a clear stop-loss in place. Placing stop-loss orders correctly is a skill. For buy trades, the stop-loss is typically set below a recent support level. Alternatively, it can be placed below the 50-period MA. For sell trades, the stop-loss is usually set above a recent resistance level, or it can be placed above the 50-period MA. Avoid setting stop-losses too close to the entry price. This can lead to premature exits on normal market fluctuations. Give the trade enough room to breathe, but control the risk. Position sizing is another cornerstone of sound risk management. You should never risk a large portion of your trading capital on one trade. A common guideline is to risk only 1 to 2% of your account balance. Calculate your position size based on your stop-loss distance. Also consider the percentage of capital you are willing to risk. This ensures that no single losing trade significantly harms your account. Proper position sizing is vital for long-term survival in trading. It helps manage drawdowns and preserve trading funds. Finally, continuous refinement and awareness are key. Always monitor market news and major economic data releases. Events like interest rate decisions or geopolitical news can impact gold. Be prepared to adjust your strategy if market conditions change significantly. No strategy works perfectly in all market environments. Above all, practice patience and maintain discipline. Wait for clear, high-probability signals according to your plan. Sticking to your trading plan and managing emotions are paramount for success.